Hi everyone, so I have my top 5 things to look out for in the week ahead. And of course it's the first week of the third quarter, and so do want to have a little bit of a discussion amongst those 5 things about what an absolutely epic second quarter we just had, one of the absolute best quarters on record. And so of course that just big question being what happens in Q3 after such a massive Q2. Now, talking of quarters, it does remind me a little bit of something I heard recently. This was in America. A doctor was in a hospital, asked the nurse, what happened to that boy who swallowed all those quarter coins? The nurse said, no change yet. All right, stand by for my preview of the week ahead. Okay, number one thing to look out for is the ISM non-manufacturing from the United States. Just it's important for a couple of reasons. One is that we saw manufacturing, so the ISM manufacturing data boom into positive territory last week, so it's actually expanding again. And we saw an absolutely huge, gigantic US jobs report last week. So the economic data is increasingly looking good for the United States, and we want to see that continue in terms of services. We're still expecting a below 50 reading for this ISM manufacturing, but if it can pop above 50, that would obviously be great news for the economic revival. Number 2 is that the RBA are setting interest rates next week. So interest rate probably going to remain at the record low of 0.25% again. And it's interesting because the RBA have been some of the most bullish, the most hawkish central banks. So Australia recently had a bit of an uptick. Melbourne has had selective lockdowns. We've had some of the highest cases in Australia since April. And so it'll be interesting to see if the RBA lose some of that hawkishness, if they hint that if it were to continue, they might have to act. That might undo some of the recent strength in the Australian dollar, which has really been firing up alongside the S&P 500 and has had an absolutely massive quarter, especially against the dollar. Okay, the other thing to look at was Chinese inflation data. We've got CPI and PPI from China coming out this week. And so, again, important because China a little bit ahead of the rest of the world in terms of its economic reopening. Not necessarily going to expect to have any massive ramifications on the yuan. Probably as anything, the China reserves data the day prior would actually have more of an impact on yuan. But again, on the Australian dollar and on just global stock markets, we want to see China doing well and kind of setting the path out for improvement for everyone else. And so CPI, obviously inflation will be moving up if economic activity moves up. And so particularly on that production front, we want to see that meet or exceed expectations just to keep the idea of economic growth going. And again, just why I'm highlighting some of this data is that we just want the data to keep tracking higher, so there's a little bit less concern about the rising cases of the virus globally. So the fourth thing on the list was just these economic forecasts from the European Commission. Not that these forecasts are ever likely to come true, but we have seen these agencies getting pretty dour in their forecasts of late, and we would expect another downward revision from the European Commission. Not putting massive weight on this in terms of a big driver for markets, but the more the forecast gets set lower, the interpretation for markets in the last quarter at least has been that this just means that governments will spend more and central banks will print more money in order to keep the recovery going in the face of such bad forecasts. So actually, not necessarily a belief that these forecasts come true, but it's more about the policy response to try and avoid them that markets are reacting to. And last but not least was just what I mentioned in the introduction there, is about the quarterly performance in Q2. Let's just run down some of the details there. S&P 500 up over 20%. Best return since 1998, predating the dot-com bubble. The Dow Jones, best monthly return since 1987. Oil, best return in 30 years for the quarter. Gold, up near 8-year highs, and best since 2016. And even in currency markets, they're a bit more choppy. We're trying to get a direction on the dollar, but still mostly a pretty weak quarter for the US dollar. It was really dollar weakness across the board with some real outperformance, as we mentioned just prior, with the Australian dollar. So the question is, can all that continue? Well, let me just quickly talk about the fundamentals, then I'll talk a little bit about the psychology of it. Fundamentals wise, Okay, I think it pretty much stacks up as in we've priced in a recovery now, more than priced in, just the fact that we're not going to go back down to a full lockdown and the economy is not going to come to a complete stop like it did in March and April again. So it's just a matter of how quickly or how slowly the economy recovers. So we do need to see the economic data continue to track higher in order to have that belief in the economic revival. The other thing is that, of course, governments and central banks have been spending huge amounts of money, and we need to see that continue. So if the data does drop, that doesn't necessarily need to be the end of the rise in these markets that are pricing in economic growth. It just means that they have to set back when that happens, but they need a policy response. And so we do have the prospect of the EU Recovery Fund being agreed in this quarter, and we have the prospect of a second stimulus package in the United States and small little government stimulus packages elsewhere. So if all those fundamental parts play in together as they have in the last quarter, it spells out more gains in the markets. The risk to the overall situation, of course, is the pandemic. We don't know how it turns out yet. We don't know if the second wave that we're seeing a little bit in some places now really picks up and forces a full lockdown. We did hear a WHO official suggesting that might be necessary. Doesn't seem likely at this point. And of course, as we head into autumn, the question is, how does this virus interact with the flu? We don't know. Of course, all the vaccine news is good, but still most people think we're not going to have a vaccine this year, so it's no immediate fix. They're all the fundamentals. What's more interesting actually is that if you look back in history and you look in terms of when the S&P 500 has had an absolutely massive quarter like it just did, in the 10 best quarters the S&P 500 had since 1950, in all 10 of those instances, the following quarter saw a positive return. And actually 9 out of 10 of those, then there was a positive return a year later in the stock market. So actually, the psychology of it is that sellers have been completely washed out here. The sellers are completely demoralized, don't believe in their position anymore after being so consistently wrong in the quarter. And so the conviction there from sellers has gone. Yes, some of the buying momentum has gone too, but without that influx of new sellers and without a trigger from those fundamentals, actually the buying can continue, but just probably not at the same pace. Right, that's it for the video this week. Thank you very much for watching. And of course, if you do enjoy these and don't want to miss the next one, make sure to subscribe to LCG on YouTube and social media, and of course, including Instagram.